So housing really is not as expensive as people think. They think it's expensive because they only compare it to one thing, the US dollar. And if you look at it that way, well, hey, Sonny, 52 years ago, my mortgage payment was $127. Now it's $1,500. Yeah, but the dollar is worth a lot less than it used to be. So you have to do the inflation adjustment, right? And so CPI inflation says it's 195, which is a little bit higher than it was in 1972. And you can look at it any time period you want. But here, Shadow Stats, it's only $58.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
What happens in this environment is inflation just destroys the standard of living for people, which Jeff, to his point, he alluded to that completely. But what's interesting about it is the powers that be, whether it be the government, the Federal Reserve, they somehow think the economy is doing well if asset prices are going up through the roof, but consumer inflation is relatively tame, right? Like asset prices going up, that's great when the stock market's going up, when housing's going up. That's all great news with the powers that be. But consumer price inflation, oh, no, we can't have that, right? Yet Biden has done everything to cause that, which is unfortunate and very sad. But, I'll just share my screen for a second and show you something that's kind of interesting. And I don't know where this will take the conversation. But, for my Hartman Comparison Index, we did an analysis of housing payments. And back in 1970, 52 years ago, the mortgage payment on the median price house was $127. Today, adjusted for inflation, it's $195. Now, granted, this is at 4.68. Rates got a little higher than that since the last time we did this, so we got a little bit of an adjustment. But this is the payment today, $1,477 on that median price house. $195 if you believe the government's lie called the Consumer Price Index, right? And so I'll get to that one in a minute. And so this is that mortgage payment over the years, right? Adjusted for CPI inflation, which is manipulated low through weighting, substitution, and hedonic indexing, right? They want to lie to us about the CPI because it's beneficial to the government. But here's what's interesting. If you look at the way they used to figure the consumer price index before, the high inflation of the late 70s, early 80s took effect, and Volcker came in and fixed that problem by breaking the back of inflation with mega high interest rates that, to Jeff's point, the government cannot afford because there's no way they could pay the debt. Like, they can't pay the debt now. And imagine if they had to service that debt at, 15% or something like that, it'd be absolutely impossible. So that is a statement for low interest rates in some reasonable range to continue into the future. But go to shadowstats.com. I had the founder on my show, John Williams, and he simply says, well, what if we just use the old method of figuring inflation before they really started to manipulate it like crazy in about 1980? And so here's the CPI inflation adjustments, but watch this. Add Shadow Stats inflation adjustments, and you see that the mortgage payment in 52 years is now half of what it was 52 years ago. So housing really is not as expensive as people think. They think it's expensive because they only compare it to one thing, the US dollar. And if you look at it that way, well, hey, Sonny, 52 years ago, my mortgage payment was $127. Now it's $1,500. Yeah, but the dollar is worth a lot less than it used to be. So you have to do the inflation adjustment, right? And so CPI inflation says it's 195, which is a little bit higher than it was in 1972. And you can look at it any time period you want. But here, Shadow Stats, it's only $58. Okay. So, that's the funny thing, right? Like, the standard of living in so many ways is so much better than it was years ago, but we kind of forget that in a lot of ways. We just sort of forget that our houses are so much nicer. They're so much more energy efficient. We've got quartz countertops and nice flooring when we used to have like shitty green shag carpet and avocado green formica and crappy old appliances, right? Like, these houses are a lot better than they used to be. and they have more square footage than they used to have. But one thing that's really misleading about it, and I'm sort of arguing against myself now, is that the housing is much higher density now. So no one considers that. When you look at all these studies saying the typical baby boomer house post World War II was like 900 to 1,200 square feet in Lakewood, California, for example, or Levittown, right? But now it's 2,200 square feet. But it used to be a quarter acre or a half acre lot, and now it's a postage stamp or, a townhome, right? So that's misleading as well. But this is just kind of really interesting when you look at it. Those mortgage payments, even at the higher interest rates, aren't that high. Jeff?
So,
thoughts?
Jason, what do you mean by that? Interpret that like, so what?
Well, the so what is that in relative dollars, in constant dollars, adjusted for inflation, because everybody's salary has gone up, they're making more money, right? The dollar is just a moving target, right? This is the mortgage payment today. It's either 127 back then, 639 in 1980 when housing was super unaffordable, or whatever period you want to pick. And here's the number today with the government's number of inflation. And here's the more realistic number with shadow stats, figuring inflation the old way the government used to figure it.
Okay, so Jason, how would what Joe's asking is, what does that mean? And I think what you're saying is, it makes sense to borrow money even though interest rates are higher. Is that what you're saying?
Oh, for sure. Yeah, like we talked about earlier. And I'll just give you the visual on that because it really just illustrates it so well. So, yeah. So everybody's complaining about the high rates, right? So compared to what? Here's the CPI inflation. You're getting paid 2.5% to borrow. With real inflation, if we call it 15%, you're getting paid 11.7% to borrow. And that's if you don't rent the house. If it's a rental property and you rent it out, you're not even paying the debt. The tenant is. It's like the most awesome deal ever. That's why I love income property. It's just
Jason, somebody's going to say maybe, but yeah, the mortgage payments as a percentage of an average income is higher than it's ever been.
That's true,
is that true?
Because, well, I don't know that for sure, but it feels true, right? That anecdotally feels true. And so I agree with you, anecdotally at least. But I remember when my mom bought her first house, she was freaking out when I was 11 years old because her mortgage payment was $416 a month for a house in West Los Angeles. It became a rental property for many years, and she recently 1031'd it and sold it for $1.6 million, right? And that payment felt lighter and lighter and lighter over the years as inflation just debased the debt. And that's the beautiful thing about real estate, owner occupied or income property, but obviously it's better if it's income property because you're not paying the mortgage.